Good morning, YouTube, and Happy New Year. It's the last day of the year. So, I was commissioned to do a 100K portfolio, and the first month we did the portfolio, we made 6,700. We did another portfolio. Well, that was October. Then we did another one for November. This is 2013, and we made 3,800. 3,800, and then we're doing one now. We're doing December for January. So. I'm going to share that with you. This is the portfolio. I posted this portfolio yesterday, and the stocks already started to move, so you still have time to do it and follow along. And likely it's going to be kind of the same thing for January and February, but just kind of adjust the positions. I may switch out a few positions here or there, but the idea is you're going to keep it the same stocks. I'll share with you. So. Start with 100K. We made 10K. So now we're putting back 110K. So that's compound interest, right? Einstein's eighth wonder of the world, compound interest. So let's use that to our advantage. And we know that compound interest fights off the law of diminishing returns. So 6 positions. It's pretty simple. 3 cover calls, 1 put spread, 1 naked put, 1 long stock. So first one, Triple D. 3D Systems. Anybody who knows me, I've been pushing 3D for a couple years now. The market cap's about $8 billion. Be in Triple D when it crosses the 10 billion threshold. That's valuable. Okay. The stocks, went from 40 to 90 in about 2 years. So it's hot to trot. Okay, so 500 shares of Triple D. Write 5 cover calls. Stocks at 92. You're at the 95 for $4. See that? So you get $400 per contract. I have 5 contracts. That's $2,000 income. Well, you're going to use 60% cash for all of our positions. So that keeps us out of a house call, keeps us out of a Fed call, keeps us out of a margin call. So the maintenance on that with the 60% is $27,600, and that brings in $2,000, which gives us a 7.222% return. See that? See how I did that? That's position 1. Next one, QHU. Again, cover call. I've been pushing QHU. It's been doing good. QHU 360 Technologies. The stock was at 80. I know the stock went up a point today, so you just have to adjust the cover call. But it was at 80.40. $80.40. We sold the 80 cover call for $4. And you see we're losing 40 cents because we're in the money by 40 cents. So it gives us $360 per contract. 300 shares times 3 contracts. That's $1,080 income. 60% maintenance. Oh, by the way, we're doing the 4th week on this for January, the options. We're not doing the 3rd standard week because the 4th week pays better. So both on Triple D and QHU, we're selling the 4th week. The 4th week pays $4 minus 40 cents in the money. Pays $360 times 3 contracts, $1,080. 60% cash, $14,400 maintenance. That gives us a 7.467% return. See that? First 2 cover calls. Next position, Onvo. Onvo is risky because it's a new company. It's just under $1 billion market cap. When I started writing Onvo, it was like 700 million. Now it's like 900 million. So Onvo's coming up. Don't recommend it for new traders, but we put in a portfolio because it's kind of balanced with the other positions. The stock's only $9-10, so right away, I have standards, right? But we're gonna take a chance on this one. We've been writing the cover calls, and this one has been working. So let's continue. Onvo, it was 965. Wrote the 10 cover call for January. Now there's no 4th week on this. We got to do standard 3rd week because Onvo doesn't have weeklies. Okay. I got 45 cents for the 10 cover call. Now when I left the house, Onvo was already up 80 cents. It was up to 10 something. So in that case, just write the 11 cover call, no problem, right? Okay. So, anyways, I got 45 cents. Did 2,000 shares, 20 contracts on the cover call. Paid $900. $900 with 11,500 maintenance. That's 60% cash. Return 7.77%. See that? That's position 3. Next one, Netflix. Anybody who's been listening to me knows I push Netflix. Been in it for a while. So Netflix 362. Here is an interesting position because I'm doing a put spread. We're going to sell the 350, buy the 340. That's a credit spread. Okay. Sell 350, buy 340. Fourth week of January, that pays the best. We're going to get 250 per spread, 8 spreads, $2,000. So it's only going to cost us $1,000 per spread. Times 8, it's going to cost us $8,000. Get $2,000 return 25%. Now I only have one position like this in the account. It's risky because it's what I call hit and miss. When you're doing a put spread or a credit spread, likely you want to set it up so it just expires worthless, which in this case it should. Netflix maintains it. That's good. The stock's at 362, by the way, 362. We're selling the 350, buying 340, so it's like probably it'll be fine. We'll go month, hit, and then it might miss 1 month. It might even go right into the spread, and then you're going to be out that money. You're going to be out $8,000. You're going to get $2,000 premium, so you're going to get $6,000. You're going to be out $6,000. But you figure like I figured I'd do fine this month. We'd be fine next month. Just look at the chart, do your technicals, try to make it so it doesn't get hit, and then you get the money. Okay, so anyways, that's 2,000 there. 25% return. Netflix. Okay, next one, Apple. Apple, is doing good. I've been pushing Apple for a while now. Stock's at 553. We're going to sell naked put for 550. We're going to go out to 4th week of January. We're going to get 1730. That's 1,730. Now, the Apple, be prepared to take the stock. We're going to put up 60% cash. And that saves you from a call, margin call. $33,000 maintenance, and that with $1,700 income, that gives us 5.24% return. See that? Now be prepared to take the stock. And if you get assigned a stock, just go ahead and write the cover call for the following month, and just do it like that. Sell a put. If you get assigned, write a cover call like that. Pretty simple. Last position. Philip Morris. We're just gonna buy 300 shares, and we believe in big tobacco, holding consumables. So that's gonna balance your portfolio. The dividend, the dividend paid December 23rd, so it just paid. So we're not getting that dividend until March. So just hold the stock, get the stock long. Stock's at 86.25. It's gonna balance everything out. Consumables, okay, and with the 60%, we're going to do 300 shares, cost $15,000, okay. So we just spent $110,438, return $7,710, which is 7% return. So that's fine. That's the income. You're going to have the income. The stocks may kind of waver a little bit, so if you end up only getting 5,000, I won't get mad at you. You're not going to get that return every time. It might be a little more. Probably it'll be less because you'll have either stock may come down or have some assignments. But that's a portfolio. 110,000 invested, 7,700 return, 7%. That's good for December 2013 through January 2014. Happy New Year. I'll show you the portfolio. Put it by hand. See you on YouTube.